What does that Apple story tell you about the supply chain issues that we're dealing with globally right now? Does it change in any way your market strategy?
No significant changes. I think when we looked at supply chains over the last couple of months, we did expect that the semiconductor shortage largely to persist. It looked like it was a bit more structural. Well, of course, there was an impact of the COVID reopening story and the real surge in demand for consumer goods and electronic goods playing a role. It did appear that it was more structural and be longer lasting and more persistent. What I think we did somewhat underestimate is just how long these shortages and supply chain issues would last in other areas like shipping that would cause some persistent inflation, persistent higher price concerns, but broadly not impacting our investment strategy that significantly as we expect them to, in due course, to dissipate and be resolved.
Alex, Raphael Bostic from the Atlanta Fed talking about inflation being transitory, saying that transitory was a dirty word. He had a swear box next to him, and every time he used it, he's going to put a buck in there to do so. No, but I mean, to a serious point, though, it seems to be quite a lot of a pushback now from various Fed officials, in fact, global central bank officials as well, from them thinking that it's just going to be something temporary.
Yeah, I guess I wonder what the time frame is for the use of the word transitory, because you think earlier this year, first quarter, we've talked about transitory, and so at what point is it no longer does it no longer make sense? I think maybe another way to describe it is say unsustainable. We could say these price pressures that we're seeing in shipping, price pressures that we're seeing in terms of good shortages, price pressures from commodities as well. Are they sustainable or are they not? Are they driven purely by excess demand, or they're driven by temporary shortages, or they're driven by structural shortages? How sustainable are they? How likely are they to persist? I think that's more what we have to think about versus whether or not it's transitory or not. It's going to dissipate at some point. Will likely dissipate because we don't see excess demand persisting indefinitely. But it's really hard to time it. It's really hard to understand when.
Yeah, if you can't time it, how do you position for it then? Do you think markets have sufficiently hedged enough for inflation?
No, it does not appear so. When we look at investor positioning, you see still fairly large underweights in terms of cyclicals, in terms of industrials and energy, commodities, materials, et cetera. We think those offer probably the best hedge you can find. And we look at tips, we look at linkers. They're not necessarily providing a good hedge against inflation. So it's really real assets, commodities, and those kind of commodity-linked parts of the equity universe that do provide overall the best hedge. And for our clients that are concerned around persistent upward price pressures, and given what we're seeing from a pricing perspective as well, those make sense to add in a portfolio.
Alex, now, I'm just going to put this in layman's terms. So in essence, what we have is a position where the central banks are finding that they have their hands tied behind their backs. As if inflation does ramp up, then they have to do something about it.
But it's not like they can just create more chips, right?
Well, but yeah,
they do something.
They have to do something which would, to alleviate it, traditional economic theory would dictate, at least monetary policy theory, would be to put up interest rates. Now, you put up interest rates, you've got this huge amount of debt and leverage in the world. That can suppress demand. Then you get up, and what do you have? Presto, stagflation. I know that's really simple, but just putting it as simply as I can.
No, that makes sense. I think the first point is probably the most important point, is that, which Yvonne mentioned, that central banks can't alleviate supply chain issues purely through hiking rates. Hiking rates can impact in terms of weakening demand, but that's why they really have to study, is this demand driven or is it supply driven? If it's more supply driven, then do they think it will dissipate? And if they think it will dissipate, then they can largely look through it. Though if they think it's excess demand and if it's an impact of loose rates, then they could address that through higher rates to, say, weaken demand to what they see as a more sustainable rate. But that's really what they have to study, I think, first and foremost. But from a stagflation perspective, that's somewhat of a different story. And we're less concerned, particularly about the stag part, because we still see strong global growth. We still see low inventories. We still see healthy household balance sheets, which should drive consumption, which should drive, from a CapEx perspective, further business CapEx as well. And so less concerned around the weakening growth part, but are concerned around how long these price pressures will persist.
And you still prefer DM over selective EM, I see, but you've lowered your view on the UK. Is that a reflection of the power crunch that we're seeing there?
Yeah, partly the power quench. I think partly the issues that we're seeing in terms of supply issues and in the aftermath of dealing with Brexit, as well as just broadly what we're seeing from a growth trend perspective. I think the DM versus EM as well. When you look at China as by far the largest EM, the largest share of the EM securities universe as well, with China facing a growth downgrade and potential for further growth downgrades, as well as what we're seeing from a higher imported inflation perspective in some key EMs. It's hard to be really positive around EM broadly. DM, however, we see a better, more sustainable recovery from COVID. We see COVID numbers coming down. We see that broad kind of reopening play to persist.
It seems like that contagion risk is here. It's happened, right? You're seeing it from Evergrande to Fantasia to Cynic now, and even some of the other, outside of property as well. Where do you hide in that kind of environment?
Yeah, I think you have to really focus on the areas because clearly property is in the crosshairs in terms of the sector that they want to try to deleverage. They want to try to shrink as a share of the overall economy, and they also want to try to force deleveraging on some of these over-levered property developers. For an investor in China's markets, and you really have to focus on the sectors kind of the opposite end of the spectrum, the ones that are receiving continued policy support, the ones that are targeted as key strategic industries, whether that's semiconductors or EVs or renewables or advanced manufacturing, areas where China has a strength and they want to continue to develop a strength that should continue to benefit from favorable policies and from investor inflows.
Yeah, I was going to ask you about deleveraging in the property sector, because this is coming at a time when we're seeing these contracted sales, a lot of these developers right now, most of which are still in decline. How do you deleverage in a deflationary scenario?
Yeah, it's quite difficult. I think that we're seeing deleveraging, of course, usually happens somewhat naturally. You saw it in the U.S. prior to the global financial crisis. It was from over-levered households and the fact that then you saw house prices decline, et cetera. Here you see it more as policy-induced. They set the 3 red lines. They see property developers that have just continued to increase their level of leverage. And so it's very difficult, yes, in a deflationary environment. I think what they're trying to target is some of these very, at risk or very over-levered property developers as a way of just overall shrinking the size of the sector, shrinking the amount of capital and resources that flows into this, both from a developer perspective as well as from a household and a bank loans perspective. But as the IMF said, it entails some trade-offs. And given how large a share of the economy the sector has, it's really hard to walk that fine line where you do it without sparking a sharper growth downturn. So I think that's really the thing we have to focus on. And I think we have to understand exactly how much weakness in the broader economy they're willing to tolerate.
Alex, how much is the story of, what's going on in the property market in China really symptomatic of the greater China economy ultimately, or is it a chicken and egg situation, or is it something which may spark off further weakness?
Well, it's not necessarily emblematic of the larger economy. When you look at Evergrande as an example, and you look at how much they've increased their liabilities over the last couple of years, it's been far more pronounced than the rest of the economy. Even when you look at property developers, it's been far more pronounced than the rest of the corporate sector. So you do have something that stands out as something separate, not necessarily emblematic of the wider economy. I think where you do see concerns, though, is if you were to see the cash flow weaken so substantially because contracted sales come down, because access to financing is as tight, it remains as tight as it has been. Then you see a broad weakness in cash flow could mean fewer starts, fewer properties under construction, and then you see suppliers along that supply chain suffer as well from weaker cash flow. And the property, it does have linkages across, it is really the key engine of growth. It has linkages across the broader industrial spectrum. And so the weakness that emanates from there, if it's sharp enough, could create a broader weakness and a broader macro downturn. And that's really what we see as a key concern, less so of the financial market contagion, just given that it seems to be well contained.
And you still like Chinese government bonds as kind of a carry trade. Is that still the case, even if we don't get a triple R cut from the PBOC by year end?
Yeah, that is still the case. I think half of that call really rests on a positive view of the renminbi, the fact that we see it largely stable because of strong balance of payments and strong trade fundamentals, as well, just given our outlook on growth. We largely see probably more liquidity, potentially some rate cuts and rates just broadly, in terms of rates broadly
Alex?
trending downwards. And so in terms of the yield differential, it's still positive.